This is what Steven Schwarzman started with in 1987. And this is what he manages today. The purpose of this series is to lay out private equity in the daylight. I want to learn the skills, the math, and the keys towards crafting my own business. I want to be on the other side of the table one day, not just as an investor, but a founder, because of the freedom that understanding company finances provides. So no matter what you want to do, if you want to create your own business, make a startup, then you gotta understand your business model. I am obsessed with understanding how money moves at the highest level, no matter the challenge that comes my way. So this is me, Learning in Public, Episode 1, Blackstone Explained, Zero to Mastery, Private Equity. Okay, before we can get into Blackstone specifically, we need to answer the obvious question. What even is private equity? If you ask most people, they'd say something like rich people investing in companies, which honestly isn't wrong, but we can do a little bit better. Here's a simple version. Private equity is when an investor or a firm buys a stake in a private company. Not something on Robinhood, not something your uncle talks about at Thanksgiving. A private one. A company that hasn't gone public yet, or one that doesn't want to. That's the key. But here's where it gets interesting, and where most people's understanding falls apart completely. Because to understand private equity, you have to understand what makes it different from the stock market you already know. And that difference comes down to three things: liquidity, pricing, and monitoring. Let's do it. Imagine you buy Apple stock today. Tomorrow you wake up, you hate Apple, and you want out. What do? You sell. Instantly. One tap and you're done. That is liquidity. The ability to convert an asset into cash fast. Now imagine you're Blackstone. You just bought a 30% stake in a private logistics company. You wake up tomorrow and you realize you want out. Can you sell? No, you can't. You can't just sell. You have to find another investor willing to buy your stake. You have to negotiate. You have to wait months, sometimes years, and that's the liquidity difference. And here's what most people miss. That illiquidity is actually a feature, not a bug. It forces long-term thinking. Blackstone isn't flipping companies for a quick profit. They're building value over 5, 7 to 10 years. Okay, pricing. Let's get into it. In the stock market, pricing is basically a giant continuous auction. Millions of buyers and sellers every second setting the price of every share in real time. Remember the perfect competition graphs from economics? Supply, demand, equilibrium? That is the New York Stock Exchange every day. In private equity, there is no auction. There's a negotiation. Two parties, or more likely a very long Zoom call, arguing about what a company is actually worth. And that negotiation is part art, part science, and a lot of leverage. This, if you want to take a look online, is what Warren Buffett talked about, finding the value of a company intrinsically. By the way, finding out that value is one of the most valuable skills you can build, and knowing how to value something that doesn't have a price tag on it is what this channel is going to keep coming back to. Last one, and this one surprises people every single time. When you buy a stock in a public company, your rights as an investor are set by the exchange. You get voting rights based on your shares. That's mostly it. You are passive. In private equity, nothing is assumed. Everything is, the word of the day, negotiated. Before Blackstone can write a single check, their lawyers draw up a contract laying out exactly what rights they have in this deal. Board seats, information rights, approval on major decisions. They are not passive investors. They are active partners. And that distinction is the whole game. Before we move on, if any of this is clicking for you, or if something's confusing, please drop it in the comments below. I'm a student doing this in real time, and honestly, your questions help me learn too. That's not a bit, that's just the truth. Okay, so now you might be thinking, this all sounds great for Blackstone, but why would any company actually want private equity money? Why would you give up shares in your own business? Great question, and here are 4 reasons why. You know how a restaurant can open tomorrow completely unknown, but the second they earn a Michelin star, there's a 6-month wait list? That star didn't change the food. It certified the quality. That's exactly what PE investment does for a company. It certifies it. The moment Blackstone puts money into your business, the entire market notices. Banks offer better terms, suppliers want in, and top talent wants to work here. Why? Because if one of the most sophisticated investors on the planet looked at your books and said yes, that means something. The right investor equals instant credibility. Okay, number 2, the financial glow up. This one gets pretty technical, but stay with me. It's one of the most important concepts in finance, and part of this series is me teaching you the skills so that you can be part of a private equity firm when you're older. When a private equity firm invests and increases a company's equity, also known as how much the company owns, something structural changes. A better equity position leads to a better credit rating. A credit rating is how safe it is to invest, right? Corporate credit ratings typically range from C to AAA, AAA meaning a great investment. Better credit ratings means lower interest rates on debt, and lower interest rates means cheaper borrowing. This is where WACC comes in. The first formula we're going to learn in this series, the weighted average cost of capital. The weighted average cost of capital is calculated like this: total equity over total value times the cost of equity plus the total debt over total value times the cost of debt times 1 minus the tax rate. I have it written out right in front of you. The weighted average cost of capital. Think of it as the company's minimum acceptance return on any investment. The lower your WACC, the more opportunities become financially viable. Private equity investment can structurally lower the WACC. And when you lower that number, you unlock growth that wasn't accessible before. To wrap it up, the lower your WACC, the more opportunities are available. Your goal as a private equity firm is to minimize the WACC. Now, an important caveat. You don't want zero debt. The goal isn't to eliminate it. It's to find the optimal capital structure. The perfect balance of debt and equity that minimizes WACC without making the business fragile. That's where the D divided by E ratio comes in. Debt divided by equity. And this is how you track the balance. The debt over equity ratio is equal to the total liabilities, or debt, divided by total shareholder equity. Now, you might be thinking, what is the optimal capital structure? And let me tell you, it depends on the industry and the stage of the company. A mature industrial firm and an early stage skincare startup have very different answers. Now, if the WACC formula or the weighted average cost of capital formula made your head spin, drop a comment below. I will do a full breakdown video on the capital structure specifically. If enough people want it, I'm happy to get it made. I'm going to put all the skill videos together because I'm learning through this with you. Okay, number 3, the Rolodex. Blackstone doesn't just bring in money, they bring access. Supplier relationships, distribution networks, other portfolio companies that might just one day become partners. For a growing business, that network can be worth as much as the capital itself. Remember, your network is your net worth. That's cliche for a reason. So this is actually one of the reasons I started the channel. I'm building in public because I believe that every principle applies at every level. The people watching this video, the people dropping comments, people reaching out, that's a network being built. I'm a student with no Wall Street connections, but I'm not going to stay that way, and neither are you. Let's get into number 4. Okay, to wrap it up, number 4, the brain trust. Especially in early stages, venture capital specifically, private equity firms bring knowledge that founders simply don't have yet. How do you get your product into the manufacturing facility? What formulas or safety certifications does your product need to clear regulations? How do you build a management team that can actually scale past 10 people? Hard skills, soft skills, operational playbooks from doing this dozens of times across dozens of companies. Money is the tool. Knowledge is the weapon. This benefit hits differently when you're thinking about starting a business yourself because capital is only part of what you're missing when you're starting from zero. The knowledge gap is just as real, and the private equity firms, they fill both. Okay, final section, the business life cycle. Here's what ties everything together. Companies don't need money once. They need money at every stage of their timeline. First is development or research and development. You need capital just to figure out if your idea works. Number 2 is startup. Fixed assets and working capital, equipment, operations, the real cost of just existing. 3 is early growth. Sales are picking up, but you need capital to keep up with demand without breaking the business. Number 4, expansion. New markets, new facilities, more working capital once again. Number 5, you are acquiring competitors, transforming the model or preparing for an exit because you are in the matured state. And number 6, decline. Sometimes you just need capital to exit a crisis with any dignity left. Private equity exists at almost every one of these stages. Venture capital is the first 3, growth equity in the middle, buyout funds, which is Blackstone's bread and butter, at the matured stage. The capital cycle never stops, and neither does the opportunity for someone who understands it. That's going to be you. Okay, that's it. And I want to be straight with you about what this channel actually is. I'm a student. I don't have a finance degree yet. I probably mentioned that a billion times. I don't have a mentor at a PE firm. I haven't done a deal, and I haven't managed $1 of outside capital. What I have is a genuine obsession with understanding how this world works. because I want two things that most people are told they have to choose between. I want to work at the highest level of finance, and I want to build something of my own. Private equity sits right at the intersection of both of these ideals. It's where you learn how businesses work, not just from a textbook, but from getting inside them, diagnosing them, and growing with them. That's what I'm learning, and this channel is how I'm doing it in public. The networking benefit we talked about today, it's real at every level, not just for Blackstone. If you're a student figuring this out, if you're someone who wants to build a business one day, if you have a career that you want to swap up, if you're in finance and you see a kid getting something wrong and you want to correct it, please reach out. The comment section is open, and that's not filler, that's the offer. Next video, we're going to get inside a real Blackstone deal to walk through venture capital in the first 3 stages. Can't wait to see you there.